Good morning once again. Okay, come to this part. The closing rate rule. Everything I am discussing only from the context of the context if the dealing is in multi-currency trade finance. Suppose any organization it deals in multi-currency. So in that regard, Indian Accounting Standard 21 will be the most volatile standard. If I talk about this part, Indian Accounting Standard 21 is being regarded as the all the monetary items. Let me show you this part. Okay. Suppose what's this closing rate rule? What the rule is telling? Limit in the Fed. Again, the context is on PL impact. Impact is on PL. If there is an impact in the PL, it's very good. If there is no impact in the PL, then the concept is something else. Now let me tell you. Suppose every time if any bank prepares a quarterly or annual report, so it has to evaluate the foreign currency loan in its books. So evaluator is forex loan. Whatever forex loan the bank is having. Indian Accounting Standard 21, it talks about the notional gain. It talks about the notional, not national, notional. What it talks? It talks about the notional gain. It recognizes in the PL immediately. Suppose the rate changes. If the rate changes, if there is any notional gain, then it has to be recognized in the profit and loss account immediately. Now, what's the paper profit? What we are talking about, the another context, that is the paper profit. Suppose if the bank hasn't received any of the extra fund, but accounting is showing that it is a profit. So we are calling that point is that suppose number one, first context, there is an immediate profit and loss impact. Suppose the rate changes. What is notional gain? Suppose there is a loan issued of 100 million US dollars. The rate is at present, it's the $1 rupees 80. You can see this here, the value, this is the time and the forex roller coaster here. So from A point in terms of change, this 3 rupee is the notional gain. There is certain gain, and this gain has to be recorded into the profit and loss. If there is this gain, the gain has to be recorded in profit and loss account. So that's what Indian Accounting Standard 21 is talking about. So that's what it's all about, the immediate PL impact. We are talking about this part as immediate PL impact, and we call this as closing rate rule. Come here. Indian Accounting Standard 113. I'll be discussing 4 to 5 accounting standards that are very important for a banker's point of view. I'm discussing 4 to 5 accounting standards that are very important from the banker's point of view. Indian Accounting Standard 113 talks about the measurement of the fair value. Means Indian Accounting Standard 113, it is talking about the measurement. Now let me tell you this part. Actually, Indian Accounting Standard 113, it gives a hierarchy of the fair value. It gives a hierarchy of the fair value. Now, what's the hierarchy? Actually, suppose if you are valuing the derivative, and the derivative does not trade on any exchange. Suppose you are valuing any derivative and the derivative does not trade in any exchange, then Indian Accounting Standard 113 will show us what's the fair value hierarchy we are having. So let me show you the hierarchy first, then we will move ahead. Number one, hierarchy level 1. Level 1, I am talking about the highest reliability. It is whatever the, suppose level 1, it is the best example is US Treasury bond. It's the biggest example. So it talks about market price. Whatever price have been quoted in the market, we are talking about this market quoted price. Coming here to the level 2. Level 2 is this part, and we discuss it on the data we got. Means simple. If market data we have, that talks about the level 2. Whatever market data we are having, we will discuss that into the part of level 2 data. So what happens here? FR rate, whatever the valuation is there, interest rate is changing, whatever rate is we are defining here, we everything decide on SOFR. We decide it on apart from SOFR part. Coming here to the level 3, the management, the portion of management. This part talks about when there is no data. So Indian Accounting Standard 113. I remember in my CA days, it is not that much easy of calculation. Number one, if I am talking about this part, number one part, there is a market price. A market price has been quoted. There is a market price. Market price have been quoted. Come to the other. What happens here? You have got the market price. So you quote it on that price. You have got the market price. So the simple scenario, you quote it into that price. You have been given with the market price and you have to quote it on that price. So that was the part of the market price. Treasury bond system. In this model, you don't, in the level 2, this part, you don't have any market price. So definitely you will do everything whatever you are having as a observable market data. Whatever you are having as a observe, whatever you observe, your data will be on that part only. So rate is SOFR rate. Level 3 of the fair value it talks about, there is no data. So what we do in this regard, bank use its own projection report. In this regard, bank uses its own projection report. हिंदी में मैं बड़ा सिंपल तरीके से आपको बता देता हूं सर. इंडियन अकाउंटिंग स्टैंडर्ड 113 तीन लेवल में बताया गया है. लेवल 1 कहता है कि ये बड़ा आसान है, आपके पास मार्केट यूएस ट्रेजरी बॉन्ड जैसा सिस्टम है, आपके पास मार्केट प्राइस दिया हुआ है, आप उस पे रिकॉर्ड कर लीजिए. लेवल 2 ये कहता है कि यहां कोई मार्केट प्राइस डेटा, आप मार्केट से डेटा ऑब्जर्व करिए और आपके पास एसओएफआर रेट है, आप उससे इंटरेस्ट रेट स्वैप के साथ आप उसका रेट कैलकुलेट करें. लेवल 3 कहता है कुछ भी नहीं है आपके पास, तो आप क्या करोगे? तो बैंक अपना खुद का प्रोजेक्शन लगाएगा और उसके हिसाब से अपना जो डेटा होगा उस पे फेयर वैल्यू रिकॉर्ड होगा. तो दैट्स व्हाट इट्स ऑल अबाउट. Simple. That's the simple scenario regarding Indian accounting standard 103 all about. So I discussed this 3 accounting standard. Please focus. These are the major 3 accounting standard every banker must focus. 109. It talks about business model test. These all are based on IFRS data. International Financial Reporting Standards data. Okay. Next, it's talk about the same part, expected credit loss ECL on 109 accounting standard. Coming here, accounting standard 21, the closing rate rule. What will be the closing rate in the forex rate here? And then accounting standard 113, the measurement of fair value, how the fair value of any securities can be measured. There are 3 levels. I discussed it with you just now. Come here in this part. What are the operational challenge and cyclicality of this part? Aja, let me discuss. Operational challenge means you have to understand. We have been shifting from GAAP to Indian accounting standard. Focus is on that. What's the operational challenge from GAAP to Indian accounting standard? So suppose what happens, Indian accounting standards increases transparency. Transparency is very common in the whole world, but definitely there is a bit of transparency in Indian new accounting standard that relates to IFRS. So Indian accounting standard used to have that transparency. So everywhere introduction of the new standard. If suppose any of the context we are thinking to introduce the new standards, it has some operational challenges. Any of the context, if we are introducing the new standards, now the point here, this is called pro-cyclicality danger, or we call it the trap. In our Indian economic context, we call it just the context of the poverty trap. Okay, now have a look into why we are calling it as a trap. Suppose the coding starts here, this part. ECL model increase the provision. If the increased provisions are there, a huge capital will be required, or rather the capital will be blocked. Suppose in this context, I am creating huge provision. Provision increased. Provision is a non-cash expenditure, and provision used to take up the profit. As the profitability we are taking here, please avoid this kind of thing. Please avoid this kind of languages. Everything is a language. Okay, my mother tongue is Bengali. So please don't do this kind of things. We all are educated, no? This is not anything social media chats or what. So please, okay, come here. Suppose the provision increased. If the provision has increased, then definitely what is this provision? Suppose in the profit and loss, you are creating here provision. This provision is reducing our net profit. Definitely. So as the net profit being reduced, it is eating up the capital. Definitely on the whole, the capital is also being reduced. So if the capital has been reduced or if the capital we are reducing, definitely the lending will be stopped. The bank will be stopped lending and it will hit the recession. That's we call it pro-cyclicality danger. So it's the operational challenge in Indian accounting standard, or rather implementation of the Indian accounting standard. Okay, that's the operational challenge. Focus on this standard definitely, because this called as the in the world of Indian AS we call it the trap, because we can be going to the pro-cyclicality trap. Volatility, bank profit means suppose context is on the banks everywhere. No, bank's profit, it will swing on a varied rate. Suppose sudden rate, if you apply the Indian accounting standard, profit will show a huge swing. And this swing profit will come with a huge volatility of the banking system. So that's what it's all about. Have a simple look. Simple line. I discussed it about ECB architecture. It is ECB architecture means like external commercial borrowing. What I discussed in the beginning of the topic in the last session, what I discussed in ECB. ECB is talking like it's a defensive waiver, and Indian accounting standard ledger. If I talk about, it's a mathematically based. That's what is simple line here. Just moving from here and come to this part. Come to this part, all of you. I am talking about new interest rate mechanism. I am talking about this part, the new interest rate mechanism. Have a simple look here. It is new interest rate mechanism. Okay, focus. It's the death of the giant. ये यहीं से शुरू है. It's just the death of the giant, and it's the death of LIBOR. Earlier, what happened? We completely followed the LIBOR principle. Okay, the LIBOR from the last 40 years, we are following the LIBOR. It's the world's most important number. If I talk about the LIBOR data, it's near about over $300 trillion of assets, impacted instrument. But actually, what happens? LIBOR has been removed, and after the removal of the LIBOR, we are having the rising of the risk-free rates. The LIBOR has been removed, and we are focusing on the rise of the risk-free rates. Okay, let me show you first that what was the LIBOR work. Yeah, how used to LIBOR work? Yeah, how does a LIBOR working used to do? Have a look into this part first. Simply, maybe any of the foreign banks like Barclays, you can call. Suppose any of the foreign bank is lending money from another bank. So what's the rate? What's the rate? It is LIBOR. Suppose anyone lending money from another bank, what's the rate? Rate is very simple. Rate, if I am talking about this part, it is the LIBOR here. Now, talking about the context of this, if I talk about the context, actually, if I talk about LIBOR as a whole, let me listen to my words. So, if I talk about LIBOR as a whole, LIBOR is based on the panel bank system. LIBOR, it is completely based on the panel bank system. Okay. Suppose every time, what rate could you borrow money from another bank? So it's the LIBOR rate. LIBOR is London Interbank Offered Rate. Remember this part also. LIBOR, what is this part? London Interbank Offered, London Interbank Offered Rate. That's the LIBOR rate. One bank takes money from another bank, near about 300 trillion, maybe in derivative, maybe in loan, maybe in mortgage, everywhere. Problem is very easy. Actually, LIBOR, it was an estimate. LIBOR is not a transaction. Get it in very clear. LIBOR is not a transaction. LIBOR is just an estimate. Now, what happens? Actually, the whole problem starts in 2012. 2012, it was discovered that banks were fixing these numbers to profit from their own trading position. What happens? Banks were fixing the numbers to profit from their own trading position or to look healthier in that. Suppose that's LIBOR rate. What happens? London Interbank Offered Rate. Banks were fixing the numbers. Why they are fixing the numbers? Just to get profit. They want profit from their own trading position. If I talk about their own trading position, they want profit from that. As they want profit from their own trading position, or rather, they want to look healthier. Their balance sheet wants to look healthier. In that context, there was a scandal of LIBOR rate. Yes. All the regulators decided that LIBOR must die. Means whoever the regulators are, regulator decided the LIBOR must die because it lacks the transactional integrity. Whatever the transactional integrity we are having, LIBOR is lacking that. As LIBOR is lacking all the transactional integrity, on that context, it has been decided to remove LIBOR. That's the change of interest rate structure. That's the change of mechanism. Okay. Actually, what happens after this? It is the SOFR. After this, the SOFR starts. I am coming back to this part because that we have discussed earlier about SOFR. So it is the death of LIBOR and start of SOFR. Okay, death of LIBOR and start of SOFR. Now come here to this part. The rise of risk-free rate. Yes. Earlier, LIBOR, high risk, they have been fixing. So on that context, the world is moving from expert judgment to actual transaction date. This is the keyword line. The world is moving slowly and gradually in 2012 from expert judgment to all start of SOFR. Coming here, context. Actually, they all are based on the overnight market. Okay, where loans are generally backed by government collaterals. Actually, they can be visually risk free, but actually these are the point here at the risk free rate, because generally they all are backed by government collaterals, and whenever they all are backed by government collaterals, they are virtually making the risk. A new standard US dollar SOFR. It causes the new standard, and here the risk-free rate coming into the market, and here we are coming with the new standard, naming the SOFR. SOFR is the secured overnight financing rate. SOFR talks about secured overnight financing rate. It is the US dollar replacement of LIBOR. Earlier, LIBOR fixed by London overnight rates, and it is just the recovery. It's the repo market calculation engine. Here, if I talk about the rate start here, repo market, banks, what happens? Banks borrow money overnight. You can see it's an overnight money. Banks borrow money overnight, and what happens? and using the treasury bond as a collateral. Banks borrow the money overnight and they use the treasury bond as the collateral on that figure. It's just like our call money in Indian market. So this is what the repo market calculation engine, and there is a secured overnight financing rate, and it is the US dollar replacement of our US dollar replacement of the Libor here. Okay, actually, Libor was based on there are certain opinions, but SOFR it is based on point of SOFR, if I talk about, then SOFR it is particularly based on a one. If I talk about this part, it is next to impossible to manipulate the SOFR. Actually, what is the global? So US dollar, SOFR. If I am talking about the Great Britain, it's the Sonia. Sterling overnight index average. Suppose it's Japan, it's Tona, Tokyo overnight average rate. It's Euro, it's Euro STR, Euro short term rate. In India, we call it call money. So everywhere it's a different rate. Like suppose in if I'm talking about in US, globally, a new standard is the SOFR. Is a secure used to use. Coming up, major challenge. The transitioning from Libor to SOFR, I promise it will be very easy. Okay. Focus. Actually, there are three major technical challenges. Three major. Challenge one, challenge two, and challenge three major technical challenges so that we can substitute the Libor date. One by one, let me discuss first. Actually, transitioning from Libor to SOFR is not just changing a name. If I talk about just it's changing a name, no, it's not just changing a name. Rather, it changes the whole calculation of the law. Means the whole mathematics changes. It's not just a change of the name, it's the whole of the mathematics is changing. Okay, so here the credit spread gap. What is this credit spread? If I am talk about this part, this is completely an unsecured. What is written? Let me discuss because some are telling only reading. No need to read. I will just explain what is in the picture. Suppose Libor was an unsecured rate. The bank credit risk. If I talk about the Libor, it included all the bank credit. Actually, the risk that a bank the bank credit risk means it's a risk is a bank might fail. SOFR, if I talk about this part, it is completely a secured rate. Now, it included all the bank credit risk. What happens in this part? Actually, simply one, it is naturally lower. SOFR, generally it is lower because it is backed by treasuries. SOFR, it is backed by treasuries. So if a bank simply switches the loan from Libor to SOFR without adjusting, suppose simply the rate change from Libor to SOFR, bank will lose money because so in that context, SOFR, if I talk about SOFR as it is backed by the treasuries here, so in this context, bank will lose because the rate is a bit lower. So as the rate is a bit lower, bank will lose money. So to fix this, what we do, we use credit adjustment price. We call it CAS. CAS is credit adjustment spread to make the two rate economically equivalent. Our target is very simple. We use CAS because as the rate is a bit lower, CAS has been used and we call it credit spread gap because suddenly if the rate is got changes, suddenly the rate changes, then bank will lose money. Then bank will use CAS for on that regard. So that's the main part of this first one, credit spread gap. Come here, next part. Forward looking versus backward looking. Another technical challenge we are having. Actually, LIBOR is known as a forward looking. If I talk about this part, LIBOR is regarded as forward looking. Okay, suppose interest rate means why we call it forward looking? It's because at the we know the rate of interest. Why we call it as a forward looking rate? Because at the beginning of the month we know the rate. So that's why it's the forward looking. SOFR we call it as a backward look. Why SOFR is a backward looking? Because it's an overnight rate. Okay, you only know the final interest amount at the end. What we do, there are daily rates and it is calculated by all the daily rates together. So we get to know it. Actually, definitely it's an overnight rate, but final amount at the end of the month we got to know the rate. So we call LIBOR as a forward looking and we call SOFR as the backward looking. Okay. Operational impact. Now, let me tell you this part because operational impact is also important because we need to focus on this part. Actually, it creates a lot of problem. Okay, for all the corporate treasurers who want to just to budget their cash flow in advance. Suppose any of the corporate treasurer who want to budget their cash flow in advance, then what happens in this regard? It leads to creation of the term SOFR. Like what happens? It provides a forward-looking estimate. What happens? SOFR that suddenly provides a forward-looking estimate. We call it as a term SOFR, which provides a forward-looking estimate. And that's what the another problem of change from LIBOR to SOFR. Third approach, the waterfall approach. Third one, it is the waterfall approach. Actually, every loan, we call it as in the world of finance, we call it fallback language. In the world of finance, what we call it? We call it callback language. Let me tell you this part, what we are calling it this fallback language. Let me discuss one line on this. Actually, every new loan contract, it includes fallback language. Actually, it is a legal clause that says if benchmark A disappear, then we will use benchmark B. Then benchmarks. Suppose if benchmark A disappears, we are going to use the benchmark B, or we may use after benchmark B, we go for the benchmark C. So we call this as a waterfall approach, or rather it's a fallback language. So come here to this part. This one is the waterfall approach. So what happens here? Every new loan contracts and it includes fallback language. Suppose benchmark A disappears, benchmark B will be used. So these are the three major technical challenges from transitioning from LIBOR to SOFR. I haven't been answering that Indian context is just because I know in the next slide I am going to discuss that part. So that is the reason. Let's come here in this part. I am talking about MIFOR and I am talking about from MIFOR to modified MIFOR. I am talking about MIFOR or I am talking about MIFOR to modified MIFOR. Let's talk about the legacy. Okay, legacy system is important. What is the legacy system we are discussing? Suppose in India, we use MIFOR. Definitely in India, it's not MIFOR, it's MIFOR. So MIFOR, if I am talking about it, is Mumbai Interbank Forward Outright Rate. Mumbai Interbank Forward Outright Rate, and we call it as the MIFOR. For all the derivatives, we use MIFOR. Since MIFOR uses USD LIBOR as a component, remember, it uses USD LIBOR as a major component. So it replaces the LIBOR part with adjusted SOFR. as it is USD Libor, it is replacing our means it is replacing the Libor part. It is replacing the Libor part with adjusted SOFR. Replacing the Libor part with adjusted SOFR. Solution is very simple. Solution is our MMIFOR. It is called as the modified MIFOR. Okay. So that's it. That's what actually it replaces Libor part with adjusted FOR. So we are naming it as the modified MIFOR. Warning is very simple for all the why it matters to exim, because that's also the most important part. Because most of the exims interest rate swap, maybe you want to go for the hedging of that ECBs we discussed in the earlier part. So it's all priced as modified MIFOR. Means suppose this all are priced at modified MIFOR. So that's it. So that's it. That's what it's all about, guys. Nothing else. Operational checklist contribution I told you. Just I will tell you just have a look into this part. Is it clear? Transition. It's a transitioning from Libor to SFR. It's a transition of Libor RFR. Okay, risk-free rates. Clear, I hope. Okay, as there are many questions, because I know in the next slide it's there. Next, let's come to the next part. Next discussion will be on RBI and SEBI. This is Indian financial system part. This is the part of our Indian financial system. Definitely in the finance management portion, we have the left with forex rate management. So next session means like in the everyday morning session, I will take 2 sessions, and evening session, one of my companion will take. So he will discuss about the forex rate and its structure. Coming to this part, let's discuss about RBI and SEBI. That's the Indian financial system part. And let's discuss about these two giants. Okay. We don't have any proper date. Actually, you have been asking me for quite a long, but I don't have the proper date. Okay. So that's why I couldn't answer that. Come here. The regulatory twin peaks are RBI and SEBI. Now let's talk about these two parts. What the fundamental philosophy, what the regulatory philosophy both of these are having. First and foremost, we all know that what the regulator and how they used to operate. But everything we have to, there are many things we could discuss in this part. But everything will be discussed from banker's point of view, nothing else. Means discussion will be completely based on the banker's point of view. Come here to the next part first. Number 1. India follows completely a model of financial regulatory. Means that's the basic of India, that it follows the model of financial regularity. Definitely, many country follows this model. Means the whole financial sector should be properly regulated. It must have a proper regulatory body. So that's the regulatory system of India. So here comes the two bodies, RBI and SEBI together. Now coming to this part first. Actually, regulators, they are they have been assigned by the government. They are used to be a statutory bodies. Even RBI is formed by RBI Act. SEBI has been formed by SEBI Act. So they are the part of the statutory body system. So what happens here? Suppose if Exim Bank is lending money, if it is lending money, it will look to the RBI. Okay. Suppose if Exim Bank is helping a client issue a bond on the stock exchange, it will look towards the exim. Basics. RBI is the regulator of our banking system. SEBI is the regulator of our capital markets. RBI is the regulator of our banking system. SEBI is the regulator of our capital market. So that's the regulatory arbitrage compliance. Means like simply regulatory arbitrage means these are the two regulators in the Indian system. Come to this part, RBI. Actually, first time 1926. There was the British Commission. The name is Hilton and Young Commission. And the Hilton and Young Commission for the very first time recommended about RBI. The Hilton and Young Commission for the very first time recommended about RBI that yes, RBI should be formed. In our country also, there must be a banking regulator. Because actually at that point of time, what used to happen? North India, South India, East India, West India, they all have the different banking phenomena. So at that point of time, the British Commission thought that yes, we must have one using banking, one unique banking phenomena or one single banking structure. So on that context, for the very first time, the recommendation has been given that yes, we must form RBI. RBI must be formed. But it took a lot of time. After 9 years, in 1935, RBI established. But with the establishment, we have the RBI Act in 1934 on. Means RBI Act has been established in 94. Actually, the politically the situation was not perfect. You can see in 1926, 1927, Simon Commission came to India, like 1930, 31, a lot of problems are. Initially, when RBI has been formed, RBI's headquarters was at Calcutta. But slowly and gradually, within 2 years in 1937, the headquarters permanently moved to Mumbai. Headquarters initially was at Calcutta, but within 2 years, the headquarters permanently moved to Mumbai. Okay. When RBI has been formed, initially RBI used to be a private shareholders board. Initially, RBI used to be a complete private shareholder board. Okay. But Nehruji in 1949 transformed into, or rather nationalized RBI. In 1949, Nehruji, what he did, he just nationalized RBI, and after that, RBI has been nationalized. Okay, that's what it's all about, the basics of RBI. Now, there are many tasks. There are many tasks RBI used to follow. But remember, I will be of the task because these three are related to Exim Bank or our curry. There are many things RBI, but the point is we are going to follow these three things because these three things are the ones that required in our curry. I have a look first and foremost. RBI is the nation's custodian of nation's forex reserve. What is RBI? RBI is the custodian of nation's forex reserve. Aja, what is this forex reserve? Because everyone is saying I only read. No, dear, I can write also. So what is the forex reserve? Actually, it comprises four things together. If I talk about the forex reserve of a nation, the forex reserve of a nation comprises four things together. Number one, it's FCA. FCA is called as the foreign currency assets. Number two, hold. Gold reserve deposit with RBI as well as the gold reserve with the World Gold Council in London. So both. Number three, Let's discuss, let's talk about SDR, special drawing rights. And number four is the RTP. RTP talks about reserve trench position. RTP talks about reserve trench position. Focus this one. So this four of the things comprises together to form our country's forex reserve. And this whole forex reserve, the sole custodian is RBI. The whole forex reserve, the sole custodian is completely RBI. Now have a look at this part. The Foreign Exchange Management Act is just the Bible of Exim Bank. Definitely we call it. Means if I am talking about the FEMA Act, FEMA is being regarded as just the Bible of the our Exim Bank. Now RBI manages the capital and current account convertibility. Definitely, it's completely managed by. So, current account, actually what happens here in current account and capital account convertibility, what happens in capital account, fully convertible part, I just leave about that part. I am coming on that part later on. Actually, now let me talk about this part. It's a microprudential guardian. Actually, it's not more than it can. We can't saw it like just a. It's more than bank for banks. Okay. It what happens? RBI used to control the whole of the economic stability. Okay. So RBI, what it does, it is just the rule maker for the entire balance. RBI is just the RTP. RTP is reserve trench position. Actually, was formed. So every country has got a quota. Means this is suppose India. India's quota is 2.76. Time if you require, you can take the 2.76% of the loan from IMF. Suppose you have taken 1% of that. So remaining 1.76%, it is with IMF. You can take it as loan from any time. So that's the our simple RTP, reserve trade position. That is with IMF. Okay, investment model. So that's the RTP. That's the simple system of RTP, reserve trade position. Yeah, come to this part here first, and I'm discussing about RBI. Okay. So actually, it is the rule maker of the whole of the balance sheet that I discussed only with you. That RBI is just the rule maker of the whole of the balance sheet. Now, what happens here? Like RBI is the custodian of foreign exchange management. Earlier it was FERA, but is the custodian. So law is simply RBI manages both the accounts, means current account also and capital account also, and the convertibility also, means whether rupees will be fully converted, whether it will be partly converted. Everything is managed by RBI. Whether it may be fully convertible, whether it may be partly convertible, everything is thoroughly managed by Reserve Bank of India only. Now, simple line. Every time what happens, now let me discuss this one. Every time what happens, Exim Bank, suppose it facilitates any of the cross-border payment. So what happens? It is acting as an authorized dealer. RBI used to act as a authorized dealer in this. Sorry, Exim Bank used to act as an authorized dealer. Now, suppose one line here. Every time Exim Bank facilitates cross-border payment, it acts as an authorized dealer under RBI delegated authority. So what it does, it is an authorized dealer as per RBI's authority here. So that's the basic part in this regard. Actually, what happens? RBI sets a limit on how much a corporate can borrow abroad. Means what happens? RBI used to set all the limits. How much a corporate can borrow, like from abroad, like in the terms of ECB, how much a corporate can borrow, or how much they can invest. We are calling it as the ODI. It's like how much they can invest. So there is the limit set by RBI in this regard. There is a limit set by RBI in this regard, how much they can borrow from abroad or how much they can lend. Next part. RBI act as the architect of banking soundness. RBI act as the architect of banking soundness. Now, what is it? Architect of banking soundness. Just have a simple look. What is this one? Actually, RBI enforces all the Basel III norms. I will discuss Basel risk management chapter. I will discuss everything about CCB, okay, capital conversion buffer, or rather RBI use our LCR, liquidity coverage ratio, or RBI present day, they are going for camels. So I will discuss. I will discuss what is car capital adequacy ratio. Everything we will discuss. Don't worry on this part. Just focus that RBI enforces Basel III norms so that the banks would not collapse. Actually, Basel III is just a risk management. Focuses on that banks should not collapse in retreat. Regard is very simple that we've thought that banks should not collapse in retreat. Now, RBI, what are the nested instrument RBI is to follow? Number one, it is CRR. Remember one line, I can tell a lot of things regarding CRR, but what we require, I will discuss on that. CRR is cash reserve risk. If I talk about this part, CRR is cash reserve risk. What is cash reserve ratio? Every commercial bank has to keep a percentage of NDTL. Remember this, percentage of NDTL, net demand and time liabilities of a bank. Every commercial bank has to keep a percentage of NDTL with RBI as a cash reserve. Every commercial bank has to keep a percentage of NDTL with RBI as a cash reserve. We call that as the CRR, cash reserve risk. CRR must be in cash. Remember this line, CRR must be in cash. It has to be in cash. Okay. CRR as per the Banking Amendment Law 2025, presently CRR is maintained on 1st and 15th of, means maintained daily, but adjusted on 1st and 15th of every month. Presently, it is adjusted on 1st and 15th of every month. That's the basic thing we need to discuss. CRR has to be in cash. Okay, CRR has to be in cash. And everything related to CRR has been mentioned in RBI Act Section 42, subsection 2. So that's what it's all about, CRR. So what happens? It's the portion of NDTL that every bank has to keep. Another. For keeping CRR, RBI does not pay any interest. For keeping CRR, RBI does not pay any interest on it. That's it about CRR. We are nearing the end of the session. So SLR, capital adequacy, yield curve, open market operations, we will discuss tomorrow. Okay. Tomorrow morning 2 sessions I will take. So we will discuss in that. Thank you to all of you. Bye.
Thank you, sir.